right, everyone. Well, good afternoon. Thank you all for attending. My name is William Wiebe from CompStak. I'm part of our enterprise team based out of Los Angeles. CompStak is a leader in providing accurate lease and sales transaction data. Our data is a trusted source of truth by some of the largest financial institutions globally, as well as some of the most reputable names in commercial real estate. We're super excited to share our winter 2023 fireside chat to discuss some of the most pressing questions around the performance of LA's industrial inland empire. We have two great panelists today that I would like to introduce. Our first is Justin Smith, who is a senior vice president at Lee and Associates Irvine office and has been with the firm his entire 20-year career. He has completed over 600 lease and sales transactions in his year, valued at $500 million and roughly 10 million square feet. He works extensively through Southern California industrial markets and has completed his work across over 15 states across the country. He completed his undergraduate studies at UC Irvine and his graduate studies at USC, earning an MBA in real estate development. He recently published his first book, Industrial Intelligence, in 2021, that is a guide for helping tenants make informed real estate decisions. He also published another book last month called Industrial Income, which is a guide for investors on how to maximize the value of their commercial real estate assets. Also here from the CompStak end, we'd like to welcome Ali Bauman, who is our Director of Real Estate Intelligence at CompStak. Previously, she had worked at Newmark's New York City office, focused on office market research, and previously led a research for the Alliance of New York City's largest business district improvement. We have a lot to cover in the next hour and would like to walk you guys through what we have in store for our agenda. So today we're going to have a look at the industrial market dynamics and the state of the economy, industrial rent growth and concessions, leveraging CompStak data, also risks or opportunities with upcoming lease expirations and expiring CMBS debt, and then what's ahead for the industrial sector, specifically within this market. We'll have time at the very end to do Q&A, so feel free as you have questions to dump them inside of the chat panel. And if we have enough time, we'll answer as many as we possibly can. So without further ado, I'd like to pass it off to Ali to kick things off.
Awesome. Well, thanks, Will, and thanks, Justin, for being here. Really excited for today's talk today. Let's jump right in. We have a lot to cover. Justin and I had a few conversations, and there's lots we think that's interesting about the market today as we're approaching the end of 2023. So our first topic, we happen to be in the middle of a week, which is important for two different reasons. The Federal Reserve is meeting to discuss if they will raise interest rates. And it's also the last week to get your holiday shopping done if you want things shipped to your house. So I thought we'd start with a quick discussion of what is going on with retail spending. The retail spending, especially e-commerce, has driven a lot of the industrial growth in especially the LA market, but broadly in the US since the beginning of the pandemic. So here I wanted to quickly show, what is going on with retail spending. And this is exactly the sort of thing that the Federal Reserve is looking at to see how hot or cool the economy is running after multiple periods of rising interest rates, and if this is impacting the United States consumer. So you'll see on our left chart here, we can see that retail spending on food services and traditional retail trade is down year over year. However, spending on retail, which excluding dining, has begun to slow to a greater degree than spending on services. And in the chart on the right, we're tracking the ratio of inventory on hand in months to sales for the month. In other words, based on how things are selling now, how many months of inventory do we have before we run out, which is a metric the retail sector looks at. You can see before the pandemic, it was relatively flat, before peaking right after COVID when spending came to a halt. And then it fell to new lows through much of 2020, 2021, and early 2023. But it's been creeping up. And this is something that directly impacts the industrial sector. Justin, are industrial users, especially those that service the traditional retail industry, e-commerce or logistics, are they feeling more cautious towards the end of this year based on what's going on with retail spending and consumer goods?
Yeah, I think without a doubt. And so what you're seeing is a lot of pause in decision making and then a lot of lease renewals. And so that's where tenants will kick the can a little bit and keep what they have. But with lease renewals, they're shorter lease renewals. So a lot of people are trying to take 2 and 3 year extensions rather than the typical 5 year extensions. And then there's a lot of shedding of space. And so there are some green shoots of growth, but I'd say if anything, it's cautiously optimistic still.
Interesting. Thanks for sharing on that. So, on a related note, retail spending and goods, this is all mixed up in supply chain. I feel like the average American didn't really know like the term supply chain before COVID, but now I feel like it's a household term that everyone knows that supply chain is so important. And it affects all of us. So it seems like we're not totally out of the woods yet, but major problems have seemed to subside substantially over 2023. So this is a measure of the supply chain that's produced by the New York Federal Reserve. It's a measure of 27 different variables that measure factors like demand, capacity, lead times to show what kind of pressure we're feeling. So this metric is down substantially from its December 2021 peak. But interestingly, it's been creeping up for the past 4 months. I saw a headline yesterday which may sum this up. You can't exactly blame supply chain like you might have been able to do over the past few holiday seasons if your gifts are late or you forgot because things are a little bit better. So, Justin, this is a broad look across the entire US market about how supply chain is doing. But are users in your market feeling better about supply chain and how are they thinking about it now and how does that impact their space decisions as we're at the end of 2023?
Yeah, for the record, I've done my shopping. And then when I think of supply chain, I think of two things of what the tenant is experiencing with their ability to service their customers and like speed to customer. And then I also think of the development side of the business and completing new warehouse properties where you need roof trusses and you need HVAC units and you need roll-up doors and you need dock levelers. And then inside the warehouse, tenants also need forklifts and racking and a very narrow aisle forklifts. And so a lot of those were almost a year backlogged. And so that backlog is probably half now. And so that's very helpful on the development side, even though development is slowing, as we'll talk about later. But I think for the tenant side, the supply chain officers of the world are very busy right now, just reorienting their network. Now that things are moving a little better, they're looking to optimize.
It's interesting that we think of supply chain like the ordering of goods, but the actual mechanics, like the things that are required to like operate a warehouse, were also impacted by supply chain. It just goes to show how important it is. So moving back to focus on the West Coast market, this has been a chart that's been widely covered in the news. People have been focused on it. So for much of 2022 and early 2023, port volumes slowly start to creep towards the eastern US ports, specifically Port of New York and New Jersey, but also ports like Savannah and Houston. While port volume declined on the West Coast, this is partially as a result of problems with trade with China. They had a lot of COVID restrictions that lagged ours, as well as labor issues, which have since, I think, largely been resolved. Justin, does this jive with what you're seeing? Are market participants, concerned about, depressed port volume impacting demand? And have you seen examples of operators that opted to expand or move operations east during some of the flux of the past couple of years?
Yeah, and I think of market participants both as tenants who are using the property and then developers who are deciding where to develop and which markets are expanding. And so there's been so much change in the port with the negotiations on the West Coast and the pending ones on the East Coast, and then now the Panama Canal. I think part of the challenge is that users have to make 5 to 10 year commitments for space, where some of these issues are issues that take weeks, months, and sometimes years. And so
Yeah.
there is an opportunity to make adjustments. But I think a lot of people have to make their bet in where they need space and then build their resiliency or build their risk mitigation strategies of knowing that they can service their customers through a secondary location. So I think people are looking at more of risk and redundancy now, so that they make sure that whatever happens during the period of time, that they can still have service levels to customers that are acceptable or better.
Yeah, that makes a lot of sense. You can't necessarily predict the future, and something like the Panama Canal drought, while that may continue to be a problem going forward, but redundancy is kind of the key strategy, it sounds like.
Yep.
So moving into discussing space demand. More specifically, this is the Logistics Managers Index, which is a nationwide survey of logistics managers on a variety of metrics that impact logistics, shipping, supply chain. So this is showing warehousing capacity. So this was showing that it's much lower a year ago. And it's been creeping up pretty much since the end of 2022. This means that warehousing capacity was much tighter a year ago, and there's still a buildup of inventory following the pandemic. Now firms are moving, it seems, back to normal lean inventories. It might be because there's less demand for inventory, but also because supply chain has improved. So these managers are seeing that warehouse capacity has increased, meaning that space is more plentiful or less scarce. Justin, does this make sense to what you're seeing, that like users are either they just don't need as much space, or because of supply chain they don't need to stockpile or kind of hoard space in order to do so more recently?
Yeah, there's a couple things going on. And I think a lot of it is with the inventory and having worked through a lot of their inventory. But the excess space is turned into sublease space on the market. And oftentimes it's part of a larger building. And we're seeing some of those part of a largers turn into the whole building being available for sublease. But I think another part of it is going back to supply chain officers and trying to deal with an expensive market and coming up with different ways to work their network. So I think a lot of inventory is also going to the Midwest, and is going to Texas, and is going to other lower cost markets. And it's not like when you move inventory that your building gets smaller or that you get to downsize your lease. And so I think a lot of people are dealing with the expensive West Coast markets and how to shift some of that cost and shift some of their space utilization as a result.
That's a great insight. And I know we'll get to talking a little bit about the expensive part of that equation, how that may or may not be changing in upcoming slides. So as a result of everything we just discussed, changes in the industrial market, space needs, everyone's now paying attention to the vacancy rate in the industrial sector. Instead of it going down and down, it's creeping up a little bit, like slightly as of late. So this is the NCREIF NPI, which is comprised of institutional quality assets. It's not the whole market. It's a fairly representative picture of what's going on. You can see that it's been increasing ever so slightly since the end of 2022 for both the US and the LA Metro. But really, it's still close to historical lows. So transitioning to our next section, we're going to talk about how concerning, or is it not, this rise in vacancy, and what does it mean for what's happening with rent growth and leasing trends, and what is transacting in this market. And I'm excited to hear Justin's experience here, since he's on the ground talking to players, tenants in the market, and compare that to what we're seeing in CompStak's stats. All right, so as I said, we want to talk about rent growth. So this is top of mind to everyone, what's happening with industrial rent growth across the US, especially this market, because it's been the outstanding performer over the past few years. Here you can see in CompStak's data, a broad look across LA, Orange County, and Inland Empire. We've been posting double-digit year-over-year rent growth each quarter for at least the past 7 quarters since about mid-2021. But it's been slowing recently, creeping down to single digits, and maybe even showing a slight decline over the last quarter. We're still likely to post double-digit growth over from the last year, but this shows that it's moderating, even though it still remains expensive, especially compared to other markets. Justin, does this jive with your experience? Or tenants finally getting some relief, negotiating power? Do you anticipate this to be the same case for the next few quarters? What are you seeing in terms of pricing in your experience?
Yeah, it's so interesting to think of it being a tenant's market, yet still having tenants have to double their rent. So what part of that feels like a tenant's market? And so that's definitely the challenge on the streets these days, to now have leverage in a negotiation, but to still have it be a difficult operating environment. And so what I love is to be able to go through the analysis like this and track it real time and see this difference. And what we've experienced as we went from that Q1 to 2 to 3, that deceleration was not only a dog pile of inventory of all different size ranges, but all of the different things you see as a sign when more inventory is coming available, like open houses and like more subleases. Some tenant bankruptcies or late pays are increasing. And that's some like economic turmoil along with high values. But when rates go down, then you'll start to see free rent come available again, and then some rent reductions. And so I feel like we've kind of gone through 6 of those steps. And then now the question is, how much further do we have to go and for how much longer?
Yeah, that's really interesting. You mentioned about late pay and bankruptcy. I think we've been hearing increasingly the term like affordability. There's an affordability challenge in markets like this one, that tenants are just kind of running up against the wall in case of what they can pay to continue operating. So the past slide was a look across the broader market, but this is a big market with important differences between Inland Empire versus Los Angeles, last mile, urban, industrial, real estate. So it's pretty clear here that year-over-year rent growth has declined for each of these 3 parts of the market, although you could see that Inland Empire was a little bit stronger over the past couple years. Inland Empire's year-over-year rent growth is down about 6% from last year. Pretty sharp decline from last year's 39% growth from 21 to 22. So Justin, I know you work across this entire market as well as like other states across the country. What can you say about like what may be different in terms of like the competition between these markets? Is there one part of the market that's feeling it more than the other, or is it pretty universal at this point?
Yeah, the pandemic made people transcend geographies more frequently in the quest to find available space. And then the LA market had peak rents that for new Class A buildings were $2.50 net, sometimes slightly above there. So I feel like that increased the most and was the peak for Southern California. And so to see it come down a bit, like that makes sense to me, that was a very few users can swallow that. And then for the Inland Empire, it appreciated the most, where it used to be a delta, where it was a cheaper market than Orange County.
Right.
And it became a more expensive market than Orange County. And all signs are parts of it isn't going back. And then Orange County kind of is its own island, like where LA and the Inland Empire are very port dependent. A lot of Orange County is local owners. And then a lot of it also has a life science bent to it, where life science needs to be close to universities. So I found there to be less volatility there as a result.
Interesting. Yeah, so there are some important differences. I have found it interesting to watch the Inland Empire because sometimes finding myself checking the rent for transactions, because you think the further away that it is from kind of urban locations, the cheaper it might be. But a lot of these, that just goes to show how strong rent growth has been. So let's turn to, so let's turn to talking about the difference between tenants taking new space in the market, expanding, versus those who are staying in place, renewing, and extending. We know there was huge competition for new space, expansion space over the last few years, and new construction, especially, which drove a lot of that, which captured high dollar rents. But what has been happening with tenants who are opting to stay over the past couple of years, and now what's happening today? Many market participants, as we talked about, there's increasing push for affordability. So CompStak's data shows that rent growth has slowed across all types of transactions, whether you're taking new space or you're renewing in place. But actually, for new transactions, it's had lower year-over-year rent growth than renewals for 3 over the past quarter. So that may be showing that tenants are opting to stay in place, but still, they are facing rent growth from what their last, rent may have been from a deal maybe they signed before this period of rent growth. So, Justin, what are you seeing from tenants who are having to make these decisions to renew? Even if rent growth is slowing, they're still facing a new multiple. If you're looking at what the market rent is in the market, what are they thinking about? And you're seeing any change in recent months, more negotiating power on their part?
Yeah, it's been terribly difficult for the tenants. However, now the experience with lease renewals has to do with if you are unsatisfied with the result or with the rate, how much are you willing to risk in order to affect a lower rate? And so risk would be taking more time to negotiate and running up against the time threshold when the landlord will put your building on the market. And if your building is on the market, then you open yourself up to other potential tenants leasing the property out from under you. But you also open yourself up to not playing chicken with the landlord, but saying, okay, you don't have any new people for the building now that you're openly marketing it at X price. See, I told you it should be less. And so that's real risk. Executives are generally pretty conservative and are loath to take that risk. But because the price of space is so expensive, increasingly they're having taking a second look at how much negotiating are they willing to do in order to try and affect a lower rate.
It's really interesting. There's lots to consider. More going on, it sounds like, than just the numbers in terms of like what tenants are deciding about. So thanks for that great color.
Yep.
Okay, so now I want to talk a little bit about bulk transactions. So these are the massive users who took 100K plus, even 500K plus spaces. Sky's the limit over the past few years. So these are tenants like Amazon, logistics companies, other e-commerce companies, especially in the Inland Empire, because that's where a lot of these buildings were offered. New construction is increasingly larger and larger. They can handle and attract tenants who need these massive sizes. So interestingly, if we focus on Inland Empire, we have seen a slight decline in transaction size in 2023 versus last year, after it kind of steadily crept up over the past few years. And we also took a look at how rent growth per square foot for 100K plus transactions versus those below kind of compared. So for larger transactions over 100K, it's been growing faster than for transactions below that size, which I think is interesting. Justin, I think we talked a little bit about this, that it used to be larger the space, you're paying so much in rent, you're paying a little bit less per square foot. But it really seems like that hasn't been the case, even though rent growth has been slowing for all transaction sizes. Why do you think this is? And do you think we'll see a change, going forward, as far as large transaction pricing?
Yeah, I think e-commerce is what is the driver that helped spur that change. And so not only is there e-commerce and just that representing more demand for buildings and for larger buildings in general, then you have this concept of the older buildings being less functional, and less functional. It comes in a whole host of different attributes, from the height of the warehouse ceiling to the sprinklers and the type that are within the building, to the ability for trucks to get into the property itself, and then the truck court for actually loading and unloading, and the quantity of doors, and whether the roll-up doors are on one side of the building or on both. And so e-commerce helped bring us all into the need for having more modern buildings and larger ones. And as a result, they not only are new, but they're also more functional. And that's part of what's made that increase. And I don't see it going back anytime. I think that's what it will continue to be.
Interesting.
And yeah, I
Okay.
think for sure smaller deal sizes as well as for that graph on your left that you had gone through.
So in general, you think, these large transactions, maybe there's a temporary, reduction, but they'll warehouse properties will continue to be built like with larger sizes than historically, it sounds like.
That's what the
So,
demand wants. Yeah, whether the supply can be built and get through the like cities and counties and states might be a topic for another discussion.
right, we have little bit of a slide on that later, so maybe we can save that for then. Yeah, that's definitely a big topic we could have an entire webinar on. So we touched on this a little earlier about, what's going on with tenants. Is it becoming a little bit more of a tenants market, even though it's still expensive? So it feels a little bit cruel to the tenant to call it so. But concessions, which really have been pretty absent or minimal during the strong market of the past few years, we're seeing a slight uptick in CompStak's data. Is this another indicator of a softening market? So CompStak's data shows on the chart on the left the average ratio of the lease term that's given to a free rent period for closed lease transactions across this market. We see that it ticked up in 2023 for the first time since 2020 for all kinds of deals, new or renewals. And also, we broke this out for if you're taking new space, if we break it out for new construction, anything built within the last 5 years, the rest of Class A space that's not new, and for all other buildings. And it's ticked up for everything. But I was surprised to see for new construction that it's a higher ratio. So for new construction recently, it's up to 2.5% of a lease term given to free rent. So Justin, we talked a little bit about this in a few calls. Why is new construction have, a higher ratio? And is, tenants have more negotiating power for these new construction properties that are maybe sitting vacant a little longer than they used to?
Yeah, if they're nice and new, why do we need to give all this free rent in the first place? And
Right.
so I think we have a slew of new deliveries. And then we also have a need for face rate or like the highest base rate possible for a number of reasons. And some of that is going back to construction loans, and some of it is going back to like public companies and REITs and their reporting structure. But in order to preserve base rate, giving free rent is a modest concession in the grand scheme of things. And so for the increasing amount of new deliveries, in order to have them absorb, that's a trade-off that's well worth it.
Interesting. So likely we'll continue to see perhaps a little bit increase in this versus a larger reduction in starting rents because landlords are loath to say the building is on sale, if you will.
We don't say that. Yeah.
Yeah, we don't say that. All right, so let's talk about sublease space. I think it was maybe almost a year ago that Amazon made the headlines of putting space on the market for subleasing space or not taking new space. And, that got everyone very kind of alarmed because Amazon was top occupier, top lessor of space. And increasingly we've seen, some headlines, sublease availability increasing in some markets. How big of a deal is that? So we pulled some data about sublease pricing for LA County and Inland Empire. And it's interesting to see that there's been a widening in the pricing that for transactions that have closed for direct versus sublease in 2023. So I know in my experience with the office market, sublease space puts downward pressure on direct office rents. It competes, directly with them. Is it the same way that it works in the industrial market, Justin, or is it more complicated, in terms of the pressure that sublease space puts on other direct availabilities?
Yeah, there's some aspects of each for sure. And so if there's a bunch of sublease spaces that are directly comparable, it will absolutely have downward pressure. However, spaces aren't as comparable, just being like industrial spaces in general. And then a lot of subleases, because they're based on extra capacity, are oftentimes part of a larger property that might be demised by a chain link fence or a fire rated wall, or even just a line on the ground, or an alarm, like a security, like alarm section. So it's not all spaces add to that downward pressure, but a lot of the nuance in sublease also comes back to what is the sublessor paying on the lease that they signed with the landlord, and what is their ability to sublease in the first place. And I think a lot of that is very comparable to office markets.
Got it. Yeah, no, that's interesting. It'll be interesting to see, what happens going forward if this continues to increase in terms of availability, and what happens in 2024. All right, so we're going to move ahead and talk about some upcoming risks and opportunities. Now that we've covered what's happening, now and in the past with pricing, concessions, we're going to touch on upcoming lease expirations and a little bit on CMBS loan maturities in the industrial sector in this market. So, according to CompStak's data, we took a look, and there is some serious volume of lease expirations coming due by the end of 2025 in CompStak's data. Overall, 2026 is kind of the peak year according to what is leased today, what is expiring. So this closely mirrors what's happening across the United States in general. So regarding the leases that are set to expire in 2024, 2025, notably the majority were signed in 2019 if we go by year. So about a third of those, with the most significant year being 2020. So those 2 years I think are interesting because they precede they were likely signed before this robust period of rent growth. So they're likely underwater what the market rent is in the broader market. So if we take a look at these particular years, they're noteworthy because they precede this strong period of rent growth. In the chart on the right, you can see that for 2023 to date, the average base rent in this market is up more than 116% from 2019, according to CompStak's data. Though, as we said, rent growth has been slowing. So this means that tenants with active leases in place today are paying about 40% less on average than where the starting rent has been for transactions closing over the last 12 months. So I think that spread could mean interesting things for leases that are coming up for renewal. So Justin, do you think these kind of stats should make landlords or tenants feel confident or concerned about the next couple of years?
Confident without.
And what should we be thinking about?
Without a doubt. I feel like a lot of the public REITs will tell you that they already have 35% increases in their NOI baked into their leases that are already in place. So that would be leases that are recently signed. And then looking at this data would tell you that opportunity, even if we have softening, should still be available for at least 2 years. And then maybe that 2026 year where there's a lot of maturities, and that based on a 2021 vintage, or maybe the majority of the leases, that should be an inflection point where we can then, based on how rent growth goes from here to there, that should dictate if that's continues to be opportunity or if there's a reckoning there of sorts.
Got it. Yeah. So this as opposed to if we had compiled this slide for the office sector, the story is a little bit different. For the industrial sector, still looking fairly favorable if you are a landlord, less so if you are a tenant.
Yeah.
So we dig into these upcoming lease expirations. Here we're showing the industrial buildings across this market where at least half of their current lease space today is going to expire over the next 2 years. This is something that you can look at to see this might be an opportunity or risk depending on your vantage point in the market. So the top tenants among these expirations are probably not that surprising. Amazon, of course, followed by NFI Industries, and I'm going to mispronounce this tenant's name, but Geodis. They're key logistics providers in the market. If you break out the expirations, it's heavily in the Inland Empire, focused in the Ontario submarket, and then in the LA County in the Southeast submarket, rank high for the share of near-term expirations. So I wanted to ask you, Justin, for tenants who are facing expiration that are looking to renew, what is their timeline like? Are they being asked to consider renewing sooner or later, or are they feeling like they wanted to get in on today's rents versus wait a little bit longer? How are they thinking about that?
Yeah, it's interesting. Right now, I think the common thought process is we're like in a deflationary environment for lease rates. And so if you feel that your rate will be lower tomorrow, you should wait as long as you can. And so I think there's a lot of that in the back of executives' minds when they're making their decisions, but that you can only wait so long. And so I'd say like a 9 to 12 months is the wheelhouse for the majority of lease renewals of when the conversation begins. And it also happens to be when most options have their like a fair market valuation windows open 9 to 12 months in advance. So that's also another natural moment in time or like a mechanism in the lease contract that will cause people to start working on a renewal regardless of the like a when would be optimal for them based on the market conditions.
Got it. Yeah, that makes a lot of sense. It's the next 2 years will be interesting. So here, digging a little bit more into the industrial lease expirations. This past fall, we launched CompStak One, which brings together lease, sales, and loan maturity data. So here we're showing this is another way that you can find opportunities or risks in the market. So in addition to searching for buildings or markets with high lease expirations, you can also search for when buildings debt is maturing in regards to CMBS. So in this industrial market, we found that there was at least 77 properties with CMBS debt rolling in the next 2 years, which, as we just noted, are notably important ones for lease expirations as well. So this could be an interesting way to search for opportunities and risks when those two things coincide. So you can see within these buildings where the CMBS debt is maturing in 24 or 25, about 18% of those buildings' current lease roll is expiring during that same period. That doesn't seem like a super high amount to me, but it could mean important things for this market. Justin, do you have any interaction with evaluating, when CMBS debt is rolling or loan maturities in general, and should that impact tenants' decision or their ability to negotiate in their lease?
Yeah, a great tenant rep broker will look into who they're dealing with and then their capital structure. And so if you find a loan maturing when the lease is expiring, you have to look at if the shoe was on the other foot. If you were the bank or the lender, you're going to look at the borrower's rent roll, and anything that's expiring, you're going to ask, hey, what about this one? This is a significant part of your portfolio. What's going on here? Are they likely to renew? Are they going to re-tenant? What kind of funds will you need to reposition the property if they leave? And so knowing that's a part of the conversation, I think you can definitely take that into account. And then it depends more on what size space you have, and then how much of it as a percentage of the total portfolio or total asset that has the loan on it. I think that moves the needle as to whether that's a material piece of information or not.
Yeah, that makes a lot of sense, that they would consider all parts of the building and financing and their capital health. So yeah, thanks for explaining that. All right, so last but not least, I'm excited for this last section because we're talking about the future and looking forward to hearing Justin's thoughts on what's ahead for the sector, with focus on two key areas. So let's talk about new construction and the future pipeline of industrial space. There's been a decent amount of news coverage about how deliveries are still strong for now due to everything that was undertaken, started over the past few years. But construction starts have been falling rapidly especially through the latter half of this year, which could mean a shortfall of supply as soon as 12 to 18 months from now. For example, I saw a headline about CBRE's latest figures show that industrial starts fell by more than a third quarter over quarter in Q3, and they're down by 2/3 from last year. So this is happening because what's happening in interest rates. So even though the industrial sector has been so hot and rent growth has been growing, developers and owners are still waiting. They don't want to take the financing that's available because it is so high cost. And in this market in particular, as well as in others across the country, there's been a pushback against large scale industrial development, especially in the Inland Empire. Lots of headlines and news about development moratoriums by various counties. And I don't think there's been kind of any state action, but that's definitely kind of giving the market and developers pause as well. So here we're showing how things have trended for bulk transactions of different sizes. You can see that the bulk users, the largest users in the market who took 500K plus, 100K plus deals, they strongly did so on average in buildings that were newer. So you can see for 500K plus square foot transactions, the average building age was strongly correlated to be newer, as well as they took space in higher ceiling heights. And this is all according to CompStak's data. So Justin, my question for you, with seeing that these bulk users demand new construction that has all of those facets that you described earlier about having the right egress, ingress, technical specifications, high ceiling height, is there a danger that users might not be able to find the space they need, that like the space on the market will be obsolete for the average or industrial user?
Yeah, I think that concern is like a 2026 concern, somewhere around there, or 2025. And so what are people doing about it? And so you'll find some new development projects just on the outskirts of town or on the outskirts of certain districts or certain counties, whether that's the Central Valley or whether that's like Victorville and Hesperia, or whether that's going into like South Paris or to Moreno Valley or Banning and Beaumont. So it's definitely pushing new construction further out. But the need for ceiling height, and pallet positions, that's not going away. And I think with e-commerce, that should only accelerate, that people will value that more. And so knowing that a lot of the existing stock is lower clearance, I think it'll put the pressure on there to have the need. And I think that can cause the market to be tight for sure, without a doubt, in the next, maybe 2 years.
Got it. Yeah, so I guess industrial obsolescence is real and might be something that we should continue to pay attention to over the next year or so. Okay, so last but not least, let's take a little bit of a right turn, or a turn south, if you will. Let's talk a little bit about nearshoring, and specifically Mexico. So this is getting a lot of attention for Mexico's capability to be a center for US companies who want to open operations at a lower cost, and for various other competitive advantages. And Mexico has 102 ports. I saw from some material Justin shared with me, and we did a quick analysis of rents and how they compare to other major industrial markets, including this one. And you can see that rent growth has also been strong in the major Mexico markets. And while it remains cheaper, maybe it could catch up. So it looks like real estate is cheaper, but it's not the cheapest. So Justin, what impact do you think nearshoring will have on this market? Is it kind of a threat? Is it an opportunity? And what do you think users should think about when they're deciding whether they should move or open operations outside the US?
Yeah, I had heard a lot of this chatter for a period of time, but had not seen it firsthand with a lot of clients until the past year or so. And so some of the experiences I have had are with manufacturers who are still manufacturing in the US and who have legacy operations in Southern California. And then they're figuring out their next batch of capital investment. Where will it be? And can they continue to invest in Southern California? Or if not, where else should they invest? And so I've started to have a handful of clients look to Mexico as an alternative, and an alternative to staying in California, to moving to other parts of the country, or to wherever their headquarters is located, where they already have a advantage talent wise. And there's a lot of things that are different, and right, so you not only with different laws and regulations, but with the different real estate market and a different infrastructure, and other differences like how people get to work, or security, or dealing with industrial parks, being a slightly different than we think of it, just being like homogenous with suburbia sometimes. So
Right.
it's been a real learning curve for me as a broker and for clients to figure out how comfortable are they there, and then where within Mexico, and how would that work for them, not only logistics wise, but from a tax perspective as well. So I think those are a handful of different considerations. And then what I have not seen yet, but I've heard of, is the alternative to China, or as another way to have a redundancy in the supply chain. And so looking by the absorption numbers, they've had a tremendous amount of positive net absorption there. And it seems like Fortune 500 companies all over the place to have footprints there, and are increasingly having manufacturing footprints there. So I think that's a big trend to watch, and it will be interesting to see how more people integrate that into their supply chain.
Definitely. Well, we live in interesting times, especially in regards to the industrial market. And I think that's a great way to close up our content for this webinar. And with that, I'll turn it back to Will.
Awesome. Allie and Justin, this was pretty riveting. We've got a few questions that we have a little bit of time for inside of our QA panel. I'm just going to chime through these. So one of the questions that we have is, and Justin or Allie, I'm not sure who wants to take this one first. But the question was, some market studies show a growing spread between vacancy and availability. While vacancy has increased modestly, availability has increased much more. Why is this happening, and what does it mean?
I'm
It's a good
happy to
question.
take that. But Justin, yeah, why don't you tell us what you're seeing?
Just my first thought would be availability is space being available, but it's still occupied. And so I went back to the analogy of lease renewals and tenants having to wager their space going on the market when they are working through a renewal and they're not satisfied with the result thus far. I would think that might be a portion of that would be attributed to that.
Yeah, I agree. I think it might be a couple of things. It could be opportunistic. There might be a portion of sublease availability, which is seeing, I don't need this space, I'm not using it. Could I lease this up for the same rent that I'm paying or more? And then also going back to what we showed about, lease expirations, landlords might be listing, the space well in advance of when the space will actually be available. So I think that's, important two stats to watch.
Mm. All right, this one should be a fun one. With an election year ahead of us, what does that mean for the future of industrial within the Inland Empire? This is more speculative than anything else. What do you guys think?
I think the adage everybody starts with is that election years people delay decision making, right? Because they want to see where things are headed and where they think policy will head. And so it's interesting to think that we're at this strange point in this recession, non-recession, and this recovery in 2024, and to marry that up with the election year. So that would tell me not to expect any huge dramatic spurt of activity, Q2 or Q3. So I would just think of slow positive momentum.
Allie, any take?
Yeah, I think I generally agree. I think the fact that we are still waiting to see, well, not waiting, no one wants it, But what's happening with the economy? You know, what is the Fed going to do? Are they done cutting rates? Are they pausing? Sorry, increasing rates. Are they going to cut rates soon? And then, you know, how will that impact, you know, the election and what happens? And so there might be a period where we're just kind of waiting to see, and then things might happen, you know, once the election is sort of, you know, decided. And that might be where things are more clear.
Justin,
Unfortunately.
thank you, Allie. Justin, I've got one for you. You kind of alluded to it earlier on in the beginning of our chat here, but you know, one of the things that kind of caught my interest is understanding, you know, which submarkets specifically within LA remain insulated from headwinds, and you know, what kind of geographic attributes do these areas typically have?
Yeah, that's a great way to think about it because it's a huge, especially LA is a gigantic geographic area. And so one of my favorite ones that I've found that is rather insulated is the Mid-Counties market. And so that'd be Southeast LA County. And so that's kind of the bridge between the ports and the Inland Empire. And it has great proximity to Orange County as well. And so it was our best kept secret probably till like 8 to 10 years ago, or at least it felt that way, that rents were less than they should be, like it was underpriced. And so I feel like it's a big market. It has a lot of functional larger boxes for an infill market. And it's smack dab in the center of all three areas that people want to be. So that would be one of my favorite ones. It's probably most insulated.
Wonderful. We have another question that just came in from another attendee. How long do you think rents will decline in Inland Empire?
I love it. That's a great question. We're all anxiously participating in that and watching. I feel like it's months, right? And it's just, is it a quarter or is it 2 quarters? I have a hard time comprehending it being much longer than that. There's just too many good things going on and too many like businesses that want to be there. So while it feels like we're reverting not to the mean, but we're correcting, like this is the first quarter of negative net absorption in 14 years, not just in the past 2 or 3 years. And so long-term trend, I feel pretty good that, yeah, it's a quarter or two.
With one of the graphs that we ended up seeing that Allie referenced a little bit earlier, you know, talked about historical vacancies specifically, and now that they're, you know, slightly on the rise, can we continue to see that going forward into 2024?
Yeah, I mean, I think that's almost asking the same question in a different way, in the sense of rents go down when vacancies increase. So I would kind of think of that as the same type of timeline. Like, although there was a good amount of new inventory over the past 2 quarters, it's not as if the market is frozen. There's still a lot of activity. And so I'm not sure we're searching for the bottom, but yeah, while it feels soft, it doesn't feel like we're in free fall, or there's a lot of activity that's still out there that still leads me to be rather bullish.
And you know, kind of on that note, another attendee jumped in and was asking questions around the difference between East Inland Empire and West Inland Empire markets in terms of asking rents and vacancies. What is your take on the outlook of both of those markets? And I'm sure, Allie, you know, you and I are probably here smiling at the other end of that because it's just a few clicks for us to find out. What is your to go back to the question, is there a difference between East Inland Empire and West Inland Empire markets in terms of asking rents and vacancies? And, you know, what is your forward-looking outlook into both of those submarkets?
Yeah, there is a difference without a doubt, like unequivocally. And then what is the difference? And so lease rates, I'm working on a lease now on a 300 that's in San Bernardino. And I think we are finding somewhere around $1.25 to $1.30 net. And then working on another 300 that's in Chino. That's more like $1.57 net. And then looking at a 300 that's in the city of Industry, I think we're $1.75 net. And so that's just asking rates. And but then you also have who is willing to go further east, where like that does limit a pool of prospective tenants and how long it takes to get to the port, how long it takes to get to their customers, or just like traffic patterns. So it used to be with institutional investors that they would be comfortable. They weren't comfortable in the Inland Empire, then they were comfortable in the Inland Empire West, and then some draw the line there, and some do play in the East. And so every investor has their own, like a threshold for how far east they're willing to go. And that kind of changes the ownership profile and who the developers are as well.
Wonderful. Thank you, Justin. I just wanted to chime in, Allie, if you wanted to go to the next slide here. This concludes our fireside chat. Thank you all for the participants that shared questions and those that are listening in. For those of you who wanted to learn more about CompStak, we've got links to our company LinkedIn profile here, as well as Justin's profile. Our team will follow up with the recording and a follow-up email. Thank you all for joining us, and enjoy the rest of your week.